Let's move right on then and bring on board Jayant Acharya. He's the Deputy Managing Director at JSW Steel, joining in to discuss their quarterly performance as well as the recent fundraise via the NCD route. Mr. Acharya, thank you for taking time out. You've delivered an impressive performance in Q4, a strong operational beat. What has aided this growth and what is your outlook for FY24?
Our quarter four numbers have been good. It has been aided by a volume growth. We had a good volume growth in our Indian operations and in our overseas operations as well. The steel price cycle was in favor, and the steel prices had gone up in the quarter four. And we had the advantage of lower cost raw material, especially coking coal, flowing in from the quarter three to quarter four. So therefore, a higher volume growth, a lower cost structure, a better improved steel price, and we also had all the Indian subsidiaries and the overseas subsidiaries doing well. So by and large, this was very supportive. The volume growth was primarily driven, I would say, first India, by good demand growth. We saw a 13% increase in the Indian steel demand last year, aided by a strong government capex. We now see private capex coming in as well. We see good manufacturing activity picking up. Energy transition into renewables is also consuming a lot of steel. And we see the service component also doing quite well, which is aiding the consumption demand. And all in all, India is a very positive story. In our US operations also, we have done quite well. Ohio did very well in terms of overall operational parameters as well as volume. Baytown did very strong performance on volumes as well as EBITDA. And our Italian operations did quite well on a back of a railway orders from the Italian government. And we have a visibility of railway orders for better part of this year as well.
Right. You mentioned about 13% volume growth rate in India, but if I look at your FY24 volume guidance, it translates to single-digit growth in FY24. Why is that?
So just to clarify what I mentioned, the Indian demand grew by 13%. Our Indian domestic sales, if you were to look at, grew by 15% on our Indian operations basis, and slightly better than what India has done. And if you were to look at the overall year, India grew by 13% again. And at JSW Steel Indian operations, we have grown sales by 24%. So we have done better from that perspective versus what India has done. The export numbers have been lower, primarily because of the export duty, which was levied till November. It was taken off in November, and therefore we see exports rising from the last quarter onwards. So that's an additional window of opportunity which has opened up, and we do see that exports now will aid the overall volume story going ahead.
No, I just want to reframe that. I want to understand whether or not you're expecting a double-digit volume growth in India for FY24.
I would say that we expect, if you were to look at the year FY24, first let me talk about India. We are expecting India to grow in the region of 8%, which would mean it would add about 10 million tons with respect to the overall demand. As far as our growth in the next year is concerned for the Indian steel industry, we expect to grow maybe in a range of between 8 to 10%. Our capacity utilization, if you were to look at last quarter, was 96%. It was 90% for the year as a whole. So we are basically utilizing our full capacities which are available. And we would be continuing to do that. Our additional capacities in this year would play out in terms of volume from the Dolvi ramp-up, which is taking place, the BPSL ramp-up, which is happening, and additional capacities which are coming up both at Vijayanagar and in BPSL, which would be more back-ended for the year.
Right. You mentioned in your first answer that you see a lot of tailwinds with regards to margins. So walk us through what EBITDA per ton could look like for the full fiscal.
Going forward into quarter one, we see that while there is a softening in international steel prices because of primarily a subdued demand in China post-opening. However, we see that the Chinese government has announced certain measures to contain the overall manufacturing to similar to calendar 22, which would mean that in the remaining months of this year, the Chinese production would get moderated by about 6 to 7 million tons per month, which is basically going to aid the global sentiments and also the global steel prices. Having said that, I think even if there is a softening of prices, which we have seen in the month of May as well as in India, our prices softened by about $25 odd. We see that the raw material prices which have gone down, let's say coking coal has gone, if we were to look at on an average by $90 to $100 from Q4 average to going into the current level as we see today. This advantage will start flowing into our business from June, July onwards. So we see that the margins to that extent remains range bound and I would say reasonably healthy going into the next 2 quarters.
And you had mentioned that capacity addition is going to be a lever for growth. So is it fair to assume the 37 million tons per annum capacity target is now on track?
Yeah, so our capex, our expansions to 37 million tons in India is on track. And our capex last year, we have spent about 14,200 crores on our capex. This year as well, we have budgeted to spend about 19,000 crores plus on our capex expansions, which is for growth, cost-saving projects, and backward integration on our mining assets. So some of the mines which we have won recently, as well as the ongoing mining operations to stabilize and improve various sustainable mining operations in both Orissa and Karnataka.
Right. You also announced some fundraise along with your earnings, possibly to fund the capex that you talked about. In light of that, what would be the net debt, say, by the end of the financial year?
So as you have seen, our net debt has reduced by about 10,000 crores by 31st March of 23. And we expect that the debt will remain range bound. The only addition which we expect, likely addition which we expect is from the merger of JISPL when that happens, which would add a debt of about 3,000 crores approximately. So in spite of the fact that we have undertaken a very large capex program and are ready for the growth phase in India, our debt would remain range bound, barring this addition of JISPL debt.
Right. And given the low base of exports, do you expect the share of exports to actually jump up marginally in the fiscal?
So the last quarter, we had an export percentage of 15%. And I think going forward, we have been in this range of 15 to 20% exports and the balance 80 to 85% in the domestic. Going forward, I think we would see, because India underplay is strong, our focus will remain the domestic market. And we would see export in the range of this 15% to 20% if the opportunity is very good, continuing going forward.
Right. Lastly, Mr. Acharya, the value-added products share. You said that it's likely to hit 55 to 60 odd percent, or rather that is what the market assumption is. Is that a fair assumption?
Correct. The value-added product and special products would be in the range of 55 to 60%.
Okay, Mr. Acharya, great to have you today on ET Now. Thanks as always for taking the time out. Good speaking with you.